A very good afternoon to you. Welcome to the BBA's webinar on the Common Reporting Standard that's sponsored by Deloitte. This webinar aims to bring members up to speed on the draft guidance notes from HMRC. And my name is Philip Allen, Director of Learning at the BBA, and today to discuss these matters I'm joined by presenters Sarah Wolf-Cochran, Director of the BBA, and Tom Shea, Director in Deloitte's Financial Services team. Before Tom kicks off, may I remind you that this is an interactive one-hour webinar in which you can participate. You'll notice that underneath the slide pack, which Tom's presenting today, is a question button which you can click on, and therefore you can populate your question there. We'll endeavour to answer as many questions as possible throughout this one-hour webinar, and we'll give you plenty of opportunity to do that. However, many of the questions which I feel that you'll probably have will probably have to be answered afterwards, and the presenters have kindly agreed to stay behind to make sure those questions are answered for you. Tom, over to you.
Thanks, Philip. Good afternoon, everyone. What we'd like to take you through today is the key requirements under the Common Reporting Standard. As many of you will know, HMRC have just released some guidance, and we want to talk through the key elements of the guidance that's been released, how they impact the banking industry, and work through the practical considerations banks should take into when they're dealing with those obligations. We'd also like to take you through the key requirements in some key themed areas. So firstly, around the definitions around financial institutions and financial accounts. Secondly, around the due diligence requirements with regards to new account onboarding and pre-existing due diligence. And then finally, reporting. And as Philip mentioned earlier, there'll be an opportunity at the end for us to take your questions and provide answers. So where are we today? HMRC have, after a long wait, finally released the automatic exchange of information guidance. That was released just at the end of last week and sets out the key requirements across all automatic exchange of information regulations. The key area that people were waiting on was the requirements around the Common Reporting Standard and the European Directive on Administrative Cooperation. Those requirements have been in place under the UK regulations for some time, but it's really the guidance which gives the clarity through which financial institutions need to deal with their obligations. The guidance also sets out key considerations with regard to FATCA and the Crown Dependencies and Overseas Territories agreements. The way the manual is structured is to give the core requirements across each of the regulations and then highlight differences between the different regulations where those arise. One of the key points we want to talk through today is that almost the first words in the guidance are, this guidance is draft. And there is a key concern for financial institutions around, well, how does that actually work going forward? How much reliance can they place on the guidance as it's currently presented? HMRC have stated that there are various different elements that financial institutions can rely on, including the CRS commentary, the European DAC, and now HMRC guidance. And I think it's fair to say that really banks should place reliance on the guidance as it's currently drafted, but be aware that there are elements that continue to evolve, and so they have to allow some element of flexibility as the guidance evolves. And indeed, we expect further versions of the guidance to be published in the future as comments are made. I want to now hand over to Sarah just to talk about some of the work that the BBA has been doing in this space.
Good afternoon, everybody. I would hope that most of you are familiar with the work of the BBA and indeed involved in the BBA's lobbying and activities on the CRS. We have been engaged in bilateral discussions with HM Treasury and HMRC for some time on the development of the Common Reporting Standard. We've been participating in the HMRC CRS working group, looking at implementation for some time, and most recently, in collaboration with the Association of British Insurers, we've submitted annotated feedback on HMRC's guidance. We've also provided them with 8 technical papers bringing out the key industry issues and our concerns, and we've further followed up with a paper on the wider approach and some issues around data protection. But aside from our work with the UK government, we've also been contributing to the work of the OECD and participating jurisdictions for some time. We're represented in the European Commission's expert group on automatic exchange of financial account information, and we've been advocating via third parties such as the European Banking Federation, the International Banking Federation, and the OECD's Business and Industry Advisory Committee. All of this goes to saying we are plugged in to the various levels that are coordinating to determine the obligations of the CRS and how they are to be implemented domestically and around the world. It's quite significant that the UK was the first country to produce its legislation and regulations on the implementation, and amongst first to produce its guidance, and the extent that if we are able to influence that guidance, we can hopefully influence the rollout of the CRS around the world. So today we're very fortunate to have a very early take from Deloitte on what the HMRC guidance actually tells us, any holes and issues with it. It gives us an early opportunity to identify issues that we want to take up with HMRC, and if we can hopefully address some of those issues through our advocacy work, then we'll be saving our members some headaches over the years to come when thinking about their international operations. Anyway, you've heard more than enough from me. You're here for Tom and what he has to tell you, so I'll hand back to Tom now.
Thanks, Sarah. And just to draw on one of the points that Sarah was making there, HMRC have publicly said that for them, actually dealing with these type of regulations has been a very steep learning curve, as it has been for all industries impacted by these regulations. And they really do appreciate the feedback that has been provided by organisations such as the BBA. And so if there are queries, it's critical to raise them so HMRC and Treasury understand the challenges that they are facing. I just want to move on to the timings now around CRS, and I'm sure many of you will be familiar with many of the dates on this slide. And I think that one of the first points to make is just how quickly CRS has come round. So many of the clients that we deal with from a Deloitte perspective have only just taken a sigh of relief having got through the first year of reporting, and immediately we're into looking at the guidance for CRS coming out with 3 months or so to go until CRS actually goes live on 1 January 2016. In terms of other sort of key dates, the first reporting under CRS will come through in 2017, May 2017, and then to enable HMRC to pass that information to other jurisdictions in September. And when we get onto the onboarding requirements, those come in from 1 January 2016 with a pre-existing snapshot of clients at 31st of December 2015. So there is a lot of work to prepare and a very short time space to actually go through the guidance that's been released and identify what the key requirements are. And our recommendation would be focus and prioritise those key areas. So there are a lot of different obligations in a variety of different areas, and what we want to do today is take you through those elements and where the practical practical steps that BBA members can actually work through. So this slide just really sets out who has actually signed up to the CRS and who's actually committed as an early adopter, and those countries that are in the second wave of countries coming through. As you can see from the slide, there are a huge number of countries that have committed to this, and again that is a potentially huge increase in the burden that financial institutions are going to have to deal with, both from an onboarding but more specifically a reporting perspective. A couple of points to draw out is the wider approach that Sarah referred to earlier. We will be coming on to what those requirements are and how they impact financial institutions and our take on those. And then secondly, to note that the United States is not on this list of countries that have committed to introduce the Common Reporting Standard. Having got the ball rolling with FATCA, it seems ironic that they are not included. But there is some fly in the ointment for certain financial institutions that will be based in non-participating jurisdictions, as we'll come on to later on.
Tom, can I just ask, just for the benefit of those on the phone, the difference between the blue and the black countries? I'm guessing it's
the early adopters,
yes,
and then the later, the second wave of adopters. So early adopting countries are those from 1 January 2016, and then the second wave are from 1 January 2017.
Thanks.
What we've really tried to set out on this slide is breaking down the requirements into a number of key elements. So firstly, around identifying whether you're in scope as a financial institution. Secondly, identifying what financial accounts you hold as a financial institution. And then looking at the onboarding requirements for the holders of those financial accounts. Fourthly, looking at your pre-existing population, so that those customers that you already have on your book before the 1 January go live date. And then finally, the reporting requirements. And what we want to do is take you through where the key changes are in each of these areas, from the original FATCA regulations to the CRS, identify what our perspective is from a Deloitte position, and then also where we think there are some key implications for BBA members. So firstly, around entity classification. Many of you will hopefully be familiar with the FATCA classifications that you had with respect to depository, custodial, investment entity and specified insurance company definitions. Broadly, those map across to CRS. There is a slight change that the holding company and treasury centre definition has been clarified in the CRS guidance, and that states that that is no longer a category of financial institution under CRS and also under FATCA. Having said that, if you have used the holding company definition to register with the IRS for a GIN, HMRC have stated that they will not require you to deregister, because they allow, if there's beneficial treatment under the US regulations for FATCA, then you can use those. From a registration perspective, under FATCA, financial institutions were required to register for a GIN number with the IRS website. There is no longer that requirement for CRS, and there is indeed no registration requirement. What financial institutions will be required to do is use, for example, their UTR reference number when they're reporting to HMRC. There are potential differences for some classifications, and it's important to note that, for example, professionally managed investment entities, so in the funds context, those professionally managed investment entities in non-participation jurisdictions will actually be classified as a passive non-financial entity, a passive NFE, and that classification is important later on when we start talking about onboarding and due diligence. In terms of some key challenges for BBA members, we would recommend that you review your classifications that you made for FATCA, confirm that they still apply for CRS, and also look at where overseas subsidiaries or branches introduce business to them and that result in the UK maintaining a financial account. Check those relationships. It's going to become increasingly important to understand who maintains that financial account given the countries in scope. Also, the deemed compliant categories have been really consolidated into a non-reporting financial institution category. And again, it's important to check those if you've relied on one of those during your FATCA work. So just to think now around financial accounts. So these are the accounts that the financial institution will actually be having under CRS, and actually looking at the holders of those financial accounts. One of the key points to note is it will be important to understand which products and relationships will be actual financial accounts under CRS. For banking members, the key financial accounts will be depository accounts and custodial accounts. Under FATCA, we had a number of exempt products under Annex 2, and it will be important, and one of the key recommendations, to monitor for those exemptions as they apply to CRS to check the overlap between the two different regimes. There's been a specific change to the definition of custodial account from a person that holds one or more financial assets to any financial instrument or contract held for investment, and again it's important to note that. One of the points that we'll come on to later on is around the de minimis exemptions that existed under FATCA, and that they have actually been removed for CRS, and that will potentially impose a significant burden on financial institutions that have relied on that in the past. We would recommend that for BBA members they look through where they've used exemptions for certain financial account products and ensure that they still apply. Also, one of the points to note is that slightly outside the banking context, the exemption for publicly listed financial institutions which were caught under the investment entity definition that had equity or debt interests listed on a recognised stock exchange, those financial accounts will no longer be exempt. So those funds will actually have to identify those interests, and that has been a key change for the wider financial services industry. And now I want to move on to really some of the more meaty topics, really around the new account onboarding requirements. So at a high level, what CRS is requiring financial institutions is to obtain additional information on their individual and entity customers to identify their tax residency from 1 January 2016. There's been a lot of debate around this concept of the wider approach, and that is the process with which financial institutions can obtain the tax residency from all account holders rather than those in scope. And I've got another slide that I want to take everyone through shortly. Just to cover off some of the other requirements, in addition to collecting the tax residency, the requirements require you to collect the tax identification number, so the TIN, and for entities, their CRS status. Financial institutions will then need to have a second step of validating and testing the reasonableness of that self-certification, and then moving through to monitor for change in circumstances. There have been a number of key discussions in this area around the use of around the rules, for example, around collecting tax identification number. And one of the key elements that's been debated is whether there is a requirement to collect TINs for UK account holders, so UK residents which are being onboarded by a UK financial institution. The CRS handbook has stated, produced by the OECD, has stated that a self-certification is not valid without a TIN. However, HMRC have stated publicly and included some language in the guidance, albeit it's not entirely clear, that a UK financial institution does not need to have the TIN number for a UK resident account holder. So that is a key element to take note of, and I know that one that certainly IT departments have been very keen to understand when they're working through the requirements about whether the fields are mandatory or not. Secondly, there's been a lot of debate around whether there's a requirement to collect place of birth, and that requirement under the DAC around place of birth has been causing a lot of consternation in the market. The way the rules are set out is that place of birth is not required to be collected unless it is an existing regulatory requirement, and there's a second test that it is also captured in electronically searchable systems. In the UK, any existing requirement would be the EUSD requirements, but you need to check that second test to see whether it is also electronically searchable. If for some reason place of birth has been collected for other reasons that are not regulatory related, for example to identify account holders, then that again does not need to be reported. I touched on the treatment of professionally managed investment entities in non-participating jurisdictions earlier, and that their classification will actually alter to be a passive non-financial entity, a passive NFE. And that therefore means that a bank that is onboarding a fund in a non-participating jurisdiction will actually have to obtain information on the controlling persons of that fund. And that is potentially particularly onerous task, given that requirement does not exist under FATCA. There's been a lot of debate around the definition of controlling persons, how is that actually going to be feasible, and how to collect that information. HMRC have tried to align the rules to the FATF and the AML and KYC requirements, and our recommendation would be to understand what your position is around AML and KYC in your existing policies and align your approach to those. Indeed, some funds which are widely held may not even meet the threshold for collecting the information on the controlling persons. But again, you'd have to work through that on a case-by-case basis. In terms of some other key challenges for BBA members, we would recommend that you consider the approach to collecting self-certifications and the timing to do that. HMRC recognise that you will not necessarily be able to collect all information on a day one procedure, and there may be other day two procedures to follow up and collect information at a later stage. Again, you need to be careful when you're planning that to make sure that those policies and procedures are defined so you include that in any body of evidence later on. I just want to spend a little bit of time just working through what we really mean by the wider approach and what HMRC's position is, as I know that this has caused significant debate. Effectively, the wider approach states that financial institutions are able to collect information from all customers regarding their tax residency. The challenge came whereby how does that interact with the data protection regulations, and can financial institutions actually maintain that information if those countries and jurisdictions are not in scope for CRS? HMRC have stated that they've sought legal opinion on this point, that there is an issue of proportionality with regard to the wider approach, and they consider it possible that financial institutions are allowed to collect this information on a wider basis. It still is up to each financial institution, each bank, to determine whether they want to adopt this wider approach to enable them to collect information on all customers from 1 January 2016, which potentially could alleviate some burden later on. And given HMRC's comments, both in the guidance and publicly, around the wider approach, Deloitte's position is that would be applicable to do going forward. And HMRC have given enough evidence that they will support that if challenged.
May I, Tom, there just butt in and say, BBA and the Association of British Insurers are collaborating here to see whether we can make this as watertight as possible. So we are still lobbying HMRC very hard to get an unequivocal statement around this and to ensure that our members have the necessary cover that they need to be able to take that approach. But that's one that perhaps we don't yet have a firm answer on.
Yeah, and I guess the challenge there is around how quickly can we get that legal opinion in place, and given some of the practical challenges that financial institutions also need to implement their procedures in time for 1 January 2016. And I think it's fair to say this is not a clear-cut area, and it's very welcome the interactions that all industry bodies have had with HMRC to try and get that clear position. I just want to touch a little bit on self-certification forms. So under FATCA, there was a lot of debate around the use of self-certification forms. I think when it was just US FATCA, before CDOT came in, many financial institutions wanted to use the existing WA, W9 and US tax forms. Those tax forms will not be sufficient to cover off the CRS requirements, and therefore there's been a lot of debate around what is the format of a self-certification for financial institutions. And BIAC, the business arm of the OECD, had been working hard to actually try and produce a template form that can be used and that sets out what the key elements are. I think it's fair to say there's a lot of different points of view from different jurisdictions on the use of those forms and how they could actually be used in practice. And indeed, we are aware of many financial institutions who want to use their own forms. In terms of key information, we've set out some of those elements on the left-hand side, but it's important to note that CRS classifications, particularly on the entity side, can differ from US and UK CDOT FATCA, and so it's important that you have a reasonableness test in place to make sure that you are picking up any differences. We would also recommend that you continue to monitor for change in circumstances once you have those self-certifications in place. HMRC have stated that 90 days is a reasonable time with which to collect the self-certification. But if you are aware of any reason or have any reason to know that a customer's classification has changed, then you will need to obtain another self-certification. And it's important to have a process in place and a procedure to make sure that's captured. One of the other areas that has caused quite a lot of debate, and really one which is very valid for the banking industry is around consolidated obligations. So that what we mean here is when a pre-existing account holder is actually opening a new account, and whether there is a requirement to actually obtain new documentation on them, for example, which would be overly onerous both on the financial institution but also on the customer, and whether they would actually return that self-certification. The guidance has included some more information in this regard, saying that pre-existing account holders, new account holders can be treated as pre-existing account holders if they already hold an account. However, there are two caveats to that. Firstly, the new account must be opened in the same jurisdiction as the pre-existing account. And secondly, the new account must not require the provision of new, additional or amended information by the account holder. One of the things that we would note here is that accounts therefore opened in overseas branches would not necessarily be classified as a consolidated obligation. Having said that, one of the points that we talked through earlier was where are accounts held by overseas subsidiaries or branches actually maintained, and if they solely act as a introducer, then they could still be maintained in the UK, for example. And in that case, we could see an argument that they could be seen as a consolidated obligation, and therefore a new self-certification would not be required. We would recommend that you'd work through that on a case-by-case basis, though. So I just wanted to spend a little bit of time thinking through around the pre-existing account due diligence requirements. So those are requirements with respect to accounts held at the 31st of December 2015. And again here, the wider approach can apply. There are different rules for individuals and entities. With respect to individuals, there are two tests. So firstly, a residence test to look at the residence address that is held on file, and assuming it is the current address and you have the documentary evidence to support that, that can be relied upon to evidence the residence of that account holder. If that is not sufficient, or you do not have that information or are not confident in it, then an indicia search will need to be undertaken with respect to individuals. And again, that indicia classification approach will be quite a burdensome process to work through the electronically searchable information and identify those accounts. Again, if you identify accounts that are indicia and have indicia and accounts that are reportable, self-certification would be required to actually confirm their status. CRS requirements also have the high value requirements included, which culminate in the relationship manager inquiry. And again, we would recommend documenting that approach would be critical. One of the key points to note under CRS, and one that has caused a lot of debate, is around the de minimis threshold. So the entity de minimis threshold, which existed under FATCA of $50,000 has been removed. And that is going to significantly increase the amount of information that has to be collected by financial institutions and the work taken, particularly if they relied on that for their FATCA remediation. However, if you can utilise the residency test, we would recommend that you do that to alleviate the burden of completing the indicia search for individuals. One of the points I just want to raise here as well is around the tax identification numbers that we touched on earlier, and discussion around validation. So again, there was a lot of toing and froing around whether the format of a TIN would be required to be validated by financial institutions when they obtained that to check it correlated with the country that they've been onboarded from. It is clear that there is not a requirement to actually validate the TIN, notwithstanding the fact that the OECD will be publishing on their portal at some point in the near future the format of the TINs going forward. But that requirement will not be in place. One of the key things that will be challenging, we believe, is around documenting the controlling persons of the professionally managed investment entities and the alignment with the AML and KYC procedures. I talked through that earlier, and it's a key point that has been critical to make sure that financial institutions get right and don't create overburden on themselves by collecting additional information that they don't necessarily need in those cases, because it is going to be a challenging area. Once financial institutions have worked through their classification, there is going to be a remediation exercise. One of the ways of reducing that remediation exercise is using publicly available information, and the guidance actually sets out the publicly available information that you can use to classify entities to actually reduce the burden that is required. And there are a number of solutions that have been developed to enable financial institutions to really focus on those customers that they need to. And managing that customer interaction will be critical. Finally, in relation to due diligence, one of the biggest burdens we as Deloitte see is just monitoring those changing circumstances. Whereas before, under, just to say, for example, US FATCA, you had to monitor for changes in relation to US elements. Now you have to monitor for changes to all participating jurisdictions, and that is going to be quite challenging to make sure that you capture each of those changes and potentially send out self-certifications. And that obligation does require a lot of planning as you move through to business as usual. Just want to touch on reporting now. So the reporting requirements are broadly similar between FATCA and CRS. So financial institutions are required to report on financial accounts held by reportable persons, and the information to be reported is set out on the slide and includes name, address, TIN, date of birth, hopefully not place of birth, account balance, and indeed payments. So the key element is payments will be in from day one, not unlike FATCA where they were phased in. We expect the volume of reports to be much higher than under FATCA because of all the countries that are in scope. And therefore, it's going to be necessary to plan carefully for financial institutions to ensure that they have an appropriate approach to cover off those increased requirements. One of the key things that banking institutions are going to face is monitoring for all the different changes in the different portals. So even this year there are different submission requirements, and actually making sure financial institutions can monitor those will be critical. The final point I just want to touch on is around notification obligations. So under the rules in the regulations that have already been released by the HMRC and HM Treasury, there is a requirement for financial institutions to inform reportable persons, and particularly individuals, that information to them will be collected and reported for CRS purposes. this obligation came primarily from the DAC and has been included. We would note, however, that HMRC have clarified that that requirement can be fulfilled either by a notification to specific customers or indeed a more general update through terms and conditions. And we would advise banks particularly that there is a pressing need to update your terms and conditions, because we would say that that is the most straightforward way to fulfill that particular notification obligation. The UK budget also included a second notification, and they indicated their intention to legislate to require financial intermediaries, including tax advisors, to notify their customers around CRS, the penalties for evasion, and the opportunities for disclosure. So there is quite a significant burden coming up for financial institutions that they need to manage. In conclusion, there is clearly a lot of information to take in today, and we've only really scratched the surface around some of the key elements. And it is necessary for financial institutions to work and to understand what the guidance actually says and plan appropriately. The next few months is going to be a significant period of intense work to enable financial institutions to move to compliance. Those are the slides that I want to present today. I think we'll now move to questions, and I don't know whether we have our first question.
Do you want me to lead off? In relation to entity classification, so one of the members just said, how do they deal with those differences in the CRS FATCA classifications? How customers meant to handle, understand what might be minor differences? Is the answer separate FATCA and CRS forms? I'm not sure if there were other questions along the same lines.
So, with regard to I think it's a good question and something that everyone is being challenged by. Certainly within Deloitte, we see a lot of queries coming from our non-financial services parts of the business around even just the FATCA classifications, and this is only going to get harder with CRS. On the whole, we would hope that classifications would generally align between FATCA and CRS. However, that key point around whether you're a reportable person will increase given the increase in number of jurisdictions. I know that there have been some financial institutions who have tried to work to actually identify one form that they can use to actually send out to customers, so that burden on the customer is reduced, and actually have a FATCA classification section and a CRS classification section. One of the challenges that people face around that, though, is that if you're using, for example, the US tax forms to cover off other obligations, for example, in relation to qualified intermediary regime, you may still need to have two forms. And that is obviously going to be a particular burden on the end customer, and why many financial institutions are now looking for electronic onboarding systems to actually make that as smooth as possible for the customer and perform those validation checks when the forms come back.
Cool, thank you.
One of the other questions that we've had is, does a self-certification form need to be obtained at account opening, or is a 90-day period allowed under CRS? The way the rules work and are set out is that the self-certification should be obtained at account opening, but there is a recognition that that may be not possible, and therefore there is a 90-day period with which the self-certification can be actually obtained. If it's not, if the self-certification is not received in that 90-day period, then it's important that that account is then identified as a undocumented account, and there are requirements to annually follow up and to collect the information.
There's a related question that's probably worth tackling just now. In terms of document collection to CRS, the IRS allows scanned or PDF versions of the self-cert. The question is, does the OECD allow the same? I guess the question is, does HMRC allow the same, or must it be in paper form?
Yeah, I think it's been interesting, the evolution on the paper forms and wet signatures and using electronic forms. You're right, Sarah, that it's HMRC who are actually implementing the regime in the UK, and they would allow electronic forms to be used similar to the IRS. One of the questions we've had is around audits and what are the OECD and HMRC intending to do around the audit of financial institutions. So in this area, what the OECD have said is that they will, as part of their global peer review process, require tax authorities to review other tax authorities who have implemented the CRS regime. As part of that review, they would expect financial institutions to actually have, for tax authorities to actually have their own regime of auditing financial institutions in that jurisdiction. But it will be dependent on each tax authority to implement its own process of review. HMRC have said that they are working through that and will be bringing in some element of audit and review, whether that's through the CRM process or otherwise remains to be seen. But they have indicated that they are starting to train their staff in this area. No formal approach has been set out yet, but we would recommend for all financial institutions that they have in place appropriate body of evidence and governance and controls to ensure that if they are audited, they can demonstrate their compliance with the different obligations that we've talked through today to make sure that they are comfortable under any audit.
Tom, another question that's come in. Where in domestic guidance does it state that HMRC does not require a UKFI to obtain a TIN from a UK resident account holder?
So, in domestic guidance, was that?
Yeah.
So, in the guidance, they set out in a couple of places that the requirement to collect the TIN is for account holders that have been identified as reportable persons, and given a UK person which is being onboarded by a UK financial institution would not be a reportable person, a TIN would not be required. However, just to note that in the guidance there is an unhelpful sentence which says a self-certification is not valid without a TIN. It goes on to say that the TIN would be required for the reportable persons, but that is a bit confusing. HMRC have publicly said that they would envisage that a TIN would not be required for a UK person that's being onboarded by a financial institution. So, one of the other questions just following up on the question around audit was what breadth of documentation will be expected as part of the audit. I think it's clear that there has been no sort of formal approach outlined in the guidance which says what level of documentation is required. However, in our experience from a Deloitte perspective, we have worked through with a number of financial institutions to identify a controls framework and which identifies in each of the areas the obligation under that requirement, what the interpretation is, and what the appropriate control is, and then indeed who the actual responsible person is in that organisation. that would be included with other evidence such as minutes of steercos, project plans to illustrate how a financial institution has actually worked through to compliance.
I've got another question for you. Sorry, firing them in all directions at you. B1 residency test. So, question comes in, many FIs won't hold documentary evidence to support the address, but, they get a simple pass-fail from auto ID from a third party, like Experian or whoever. Will this satisfy the requirements?
So I think this is one of the difficult areas, and again, the documentary evidence section is not entirely helpful in this regard, in how far it goes. And we would have liked it to go further to say that you can actually rely on the auto ID approach, because that is the approach that many financial institutions actually use for onboarding their clients. I think a strict reading would say you'd want additional information. I think this is an area that's going to continue to evolve, if I'm honest.
So it's a BBA lobbying point. I take that away. Yep.
Another question around TIN validations. So, does the TIN validation requirement apply to both new and pre-existing accounts? So, just to be absolutely clear, there is no requirement to actually validate the TIN number in terms of the format. So there is no requirement to do that either for new or pre-existing accounts. Having said that, we would suggest that if a financial institution is submitting a return, that clearly all the TINs are just, for example, ABC, and then there is going to be questions coming back from a tax authority about whether they are appropriate. A couple of other questions coming in. So someone's asked what would be the time frame for completing entity classifications. So I'll just break that down into two parts. So firstly, for banking institutions themselves, around looking at what classification they are. I would recommend that you do that in very short order now the guidance has come out. I would expect that is a relatively straightforward exercise, and if you're a financial institution in scope for FATCA, then you will be in scope for CRS. The only slight point just to check is if you've used a particular category of deemed compliance, for example, then it would be worth checking that still applies under CRS. The second element of classifications is obviously onboarding new corporate clients, and that needs to be in place for 1 January 2016. And we would recommend that over the next weeks and months you put in place a process to make sure that your onboarding procedures are up and running.
I've got a bit of a googly for you. We may have to send an email on this one, but anyway. Treatment of e-money differs from that under FATCA, and it's not clear whether this recent release guidance amends the FATCA guidance. Do you have a view on what the final or the right position is? Will it be the same under the DAC?
Yeah, so one of the guidance has included some provisions around e-money providers, and they're specifically saying e-money providers that are governed by the provisions of the EU Electronic Money Directive would not be considered depository institutions. Now, we would say that specifically has been included in the wider automatic exchange of information guidance, and one of the other points that we perhaps could have noticed at the start was that the US FATCA guidance has also been updated, but no real changes have been made to reflect that. I would think that would be something we'd want to go away and check and confirm about the application both from CRS and a FATCA perspective. We've had a question on reporting. So, given the increase in countries that are in scope for CRS, will reporting be through a single file or through multiple files? So obviously, year just gone, we've had financial institutions making reports into HMRC under a single file. Under CRS, we still expect it to be a single file, but many more accounts identified in the return, and each of those accounts being identified for different reportable jurisdictions. There's been another question around exemptions for listed equity and debt. So I think that's really more a question for the wider financial institutions rather than for the banking industry. And in this point, the question has been, are HMRC considering an exemption for listed equity and debt? I think it's clear that that is not going to be coming in, and there is not going to be an exemption going forward for those type of financial accounts, though we don't expect, hopefully, that to impact the banking industry so much. So I'm just walking through different questions.
So there's another question. Is it possible to apply client CRS self-cert across multiple entities within your bank? I.e. a client may have accounts in different jurisdictions, so if they provide a self-cert for Spain, can we cross-apply this to Portuguese accounts with written consent from the client? Or is a separate self-cert required for every jurisdiction in which they have accounts?
I think that's a really interesting point. So one of the reasons that the OECD were keen to prepare a general template self-cert was to try and drive that consistency. So before CRS came in, and even before FATCA, the US were the first jurisdiction out there to really define a standard form with the W8s and W9s that many people are familiar with today. And that was, although they were perhaps overly onerous and complex, it was helpful that everyone recognised a W8BNE or a W9, and so people generally got used to what classification they were. And actually having a standard form for CRS would again help deal with that specific point. The BIAC have released a standard template, and that should be possible to use in each different jurisdiction across different banking entities. The one point I would note is that although HMRC have not defined the use of a certain self-certification form, it is possible that other tax authorities state that they want to use a particular type of form, and in that case you might need to use different ones. So again, although it's supposed to be a common reporting standard, you'll have to look on a jurisdiction by jurisdiction basis. Here's
where I do a bit of a plug, saying BBA members took an active role in helping to draft that BIAC self-cert form, and actually we now carry those templates on the BBA public website, so they're accessible from there. Sorry, go on, Tom.
And then probably just our final question, given we're coming up to 3 o'clock. Will financial institutions be expected to report on all account holders in CRS jurisdictions, or just those where the counterparty has gone live? So in this case, HMRC have stated that they will make a list available in good time before reporting. Given their timing to date, it'll be interesting to see how that plays out, of those jurisdictions where there is an automatic information exchange agreement in place, and therefore you have to report on that. It's fair to say that the DAC is the mechanism through which the regulations have been implemented in the EU, and then other countries will come on board as those jurisdictions get signed up. Given we're now at 3 o'clock, I think we'll come back separately to any questions that we've not managed to answer. Thank you everyone for submitting those questions. I think we've had a really good response, and I'll pass back to Sarah for any closing remarks.
Well, thank you, Tom and team. An excellent job of fielding some tricky, googly questions, and really pleased that you're going to be able to respond to those who we haven't been able to answer today. Over to my colleague Phil.
Yes, thank you very much everybody for attending today's webinar. I will make sure that you each get a recording of this webinar along with a PDF version of the slide pack. If you do have any questions for either Sarah or for Tom, the contact details for the respective people are on the screen as you see it. And yeah, we look forward to engaging with you on this issue shortly. Thank you very much and have a good afternoon.